Jaguar Land Rover reported an annual profit before tax of £14 million for the year to March 2026, down from £2.5 billion 12 months earlier. That is not a rounding error. That is a 99% collapse in a single fiscal year from one of Britain's most strategically watched manufacturers. And yet, the company's fourth quarter told a different story entirely. In Q4 alone, JLR posted a profit before tax of £458 million. Adjusted EBIT margin for the quarter came in at 9.2%, not far from the 10.7% it recorded in the same quarter a year ago, before the crisis hit. Revenue for the full year fell 20.9% to £22.9 billion, but the fourth quarter saw volumes and margins climbing sharply back. The question that number forces is this: if the business just delivered a 9.2% margin quarter at the end of the worst year in its recent history, what exactly does the annual loss represent? And what does the recovery trajectory mean for where capital should be positioned now? The FTSE 100 shrugged off the broader political turbulence this session. Health Secretary Wes Streeting resigned, citing lost confidence in Keir Starmer's leadership, and Jamie Dimon of JP Morgan publicly warned he could cancel plans for a new $3 billion Canary Wharf headquarters if Starmer is replaced by a prime minister hostile to banks. Oil dipped. London's headline index held its ground. But within that surface-level resilience, the JLR numbers cut to a deeper question about whether the market's prevailing reading of the British industrial cycle is actually priced on the right year. The annual loss was not generated by one bad quarter compounding into another. Three distinct headwinds compressed the full-year results simultaneously, and the timing of their concentration matters for interpreting what the Q4 recovery actually signals. First, the cyber attack. In September 2025, JLR confirmed it had been targeted by a malicious hack that forced a global shutdown of manufacturing facilities for several weeks. The Cyber Monitoring Centre estimated the incident cost the UK economy approximately £1.9 billion and affected more than 5,000 organizations. For JLR specifically, production volumes that should have landed in the second and third quarters simply did not exist. Revenue that would have been booked was not booked, and the fixed cost base continued running throughout. That is not a structural deterioration in demand. It is a forced revenue gap with a recoverable trajectory once production resumed. Second, U.S. tariffs. The Trump administration's tariffs added incremental cost pressure across the full year, widening the gap between JLR's revenue line and its profitability. Unlike the cyber shock, this headwind is ongoing. It did not resolve when the Q4 margin recovered. That distinction is the condition under which the recovery narrative breaks down. Third, the Jaguar wind-down. JLR deliberately ran down outgoing Jaguar models throughout FY26, ahead of a new electric Jaguar launch it said it would confirm later this year. Volume reduction from an intentional product transition looks identical on the income statement to demand destruction. Both reduce revenue, but the capital implication differs entirely. A wind-down precedes a launch, demand destruction does not. The Land Rover Defender Octa saw a four-fold year-on-year sales uplift in Q4, suggesting the brand's core demand did not deteriorate. What the annual number cannot show is which of those shocks is reversible and which is not, and the market's reading of the stock depends almost entirely on that decomposition. The Q4 recovery to a 9.2% margin is where the argument sharpens and where it becomes genuinely hard to call. If the cyber disruption was a one-time event and the Jaguar relaunch generates sufficient volume, then FY26 functionally represents a trough year with an embedded recovery signal already visible in the final quarter. The historical parallel that frames this is JLR's own trajectory after the 2022 semiconductor shortage, when production was similarly throttled by an external constraint. Volumes fell, margins compressed, and the subsequent year produced a sharp rebound once supply normalized. That cycle took roughly 3 quarters from supply restoration to margin recovery, which is approximately what FY26's Q4 data implies is already underway. The condition that breaks that reading is tariffs. In 2022, the semiconductor shortage resolved, and JLR's underlying cost structure was not permanently impaired. U.S. tariffs are a different mechanism. They do not resolve when production restarts, and JLR's premium positioning in the American market has historically been one of its highest margin revenue streams. If tariff pressure holds through FY27, the Q4 margin recovery may reflect an operational recovery on the manufacturing side, while the pricing power on the export side remains under compression. That would make 9.2% a ceiling, not a floor. The electric Jaguar confirmation date is the verification benchmark the market will watch. JLR said it would confirm new model details later this year, a deliberately vague timeline that gives the company flexibility, but gives capital markets no anchor. If that confirmation arrives in the next 2 quarters with volume guidance attached, the FY26 annual number becomes historical noise. If it slips into FY27 without a clear launch date, the wind-down volume gap extends and the trough year calculation has to be reopened. The annual loss of £14 million against a Q4 margin of 9.2% is not a contradiction. It is a compression of 3 distinct events into a single line. What it cannot tell you is whether the worst is over, or whether the one shock that did not reverse has enough weight to cancel the 2 that did. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.